I've got a question for the CrowdCube guys. I am a salesperson, but the idea that I have to have such a strong emphasis on selling my business, I find really difficult, because why would it's a bit like Daniel said, why would anybody think it's a good idea? Why would anybody invest in me? And it worries me a little bit compared to the very, if you don't mind me saying so, financial approach guy from the Knight's business. So two totally different approaches. Yours feels very young and American. Yours still feels a little bit safer to me. And I'm worried about the selling piece.
I'm going to help Michael redress the balance now.
Yeah.
So I think one of the great things about it is you're going to be doing marketing for your company anyway. You're going to be trying to sell your business in the best possible way anyway. It's combining it into one, and promoting yourself, bringing on new customers, potentially getting feedback from the crowd. There's so many other benefits to it. I think if you prepare to fail and you don't want to share it and you're not confident about really selling yourself, it can be difficult. I've seen a lot of entrepreneurs fail that just aren't natural salespeople. They're very good, fantastic business ideas, but they find it very difficult to ask people for money. They find it very difficult to sell. And it is one of the key characteristics of a successful entrepreneur, being able to do that and sell yourself, sell your business. And
so what happens if you go up on, sorry, can I ask a second question?
Can I stop you?
If you go up on your platform and you don't raise the finance, does that have a negative impact on the business?
We've seen there's been about 15 companies that have come back, that failed the first time, but then have come back and successfully raised the second time round. So readdressing what the issues were in the first place. Either they didn't get any traction when they first launched, or they've taken on some feedback from the Q&A about their valuation, about, it could be anything. But we don't seem to have seen that there's been a hugely negative impact. It's not something that it's very easy to track, but I suggest that it's not going to be hurting yourself to be marketing yourself and your business. Even if you're not successful, you're getting your brand out there and the word out about what you do.
No news is bad news.
Can I talk about the other side of our platform? Because I guess what I was talking about was the sifting process that we go through because we're rejecting 9 out of 10 applications, and what we really want to see on our platform are the better quality loans. But when they are going on our platform, there is a loan display, and we are encouraging people to make a good presentation of what they do. I mean, very similar to CrowdCube. We've got, I could practically recognise, the tabs on this thing. There's a lot of similar information that borrowers will present about their business, because they've got to make themselves attractive to lenders. Our role is to monitor what they say, so they're not saying anything absolutely outrageous. But it is their presentation, and we encourage them to make a good presentation. And a good presentation is going to attract lenders and get a lower interest rate.
I think the inclination, and I know it's supposed to be a trait of female business people, is to undersell yourself and the potential of your business. And that's my biggest fear, is I don't want to have to sell myself too much. Or I'm scared of overstating, so I'm more likely to understate it.
What percentage of your CrowdCube transactions are female-owned businesses?
I think it's about 15%.
15. I rest my case.
But in traditional, I think in VC and angel funding, I think it's less than that. I think CrowdCube has kind of democratized that a little bit and addressed the balance slightly.
Certainly 10.
I rest my case. We don't like selling our businesses.
Well, that's not true. We've had some really successful entrepreneurs like Emma from Silk Thread, Kate from Table Crowd. They're absolutely fantastic, and they were the most proactive entrepreneurs we've ever had. They're very good at it.
Really doing the work.
Can I ask a different question about regulation? I mean, it goes to all of you really. Can you just talk about the regulatory environment which you're operating? I mean, clearly that's a concern, I think, for all people from both sides of this. And how do you deal with the regulations? What are the regulations that apply to you?
Do you want me to start?
All four of you, really.
Well, I'll start. A year ago, the government introduced a new category, which was something like owning and operating an electronic platform that raises money for people. They had to introduce this new concept because it transcended, the whole crowdfunding movement transcended anything that had ever been done before. The great thing about setting up an entirely new basis for regulation was that they started from scratch and listened to the industry. Now, I have experience of campaigning for regulation, which was my last role, which was an equity release business, and campaigning for regulation, getting it, and then finding it was totally inappropriate. This time they've listened to the industry, and the way they have approached it, certainly on the lending side, is to go quite light on the regulatory framework, but be prepared to tweak the knobs as they go along.
Yeah.
It's a really, really good framework for appropriate regulation.
Yeah, we're getting reviewed every 6 months. So in April this year, the regulations changed again slightly, which meant that for us, we could open it up to retail investors. So agreeing to invest less than 10% of their investable portfolio every year. So that means there's now 4 ways that you can sign up as an investor on CrowdCube: advised, high net worth, sophisticated investor, and retail investor, or everyday investor. Everything on the site is checked for financial promotions, and we try to educate and encourage our entrepreneurs to understand when they're promoting their business themselves as well.
I suppose I'd give you a slightly cynical journalistic perspective, and I'd say that I think that all of that is true, but I mean my normal day job, as I write about investment, is my normal day job, and my experience of the FCA in investment is nothing short of disastrous. They are nobody from the FCA here? Yeah, about to say, lovely bunch of people. Really trustworthy, and you can always do business with them. So I think you can work out the opposite. And the thing is that whilst the government, I think, has been, as my colleagues quite rightly say, very keen to build a sensible playing field they can work in, and I believe absolutely everything they're saying. My innate suspicion is that when it becomes less sexy, and the government turns its eye to other stuff, which would take a few years or weeks if there's an election, the FCA will start to get their claws in. And the FCA have an appalling reputation in terms of micromanaging to the nth degree. They are an utterly dreadful organisation in my book, which will effectively micromanage this country into the dust. So you get my rough view. I don't like that. I said I write traditionally about investment vehicles, basically, and it's an appalling reputation of both micromanagement and proactive bashing over the head. My suspicion is that the industry's probably got about 2 or 3 years of grace. There will probably be some almighty cock-up, and Mrs. Biggins will lose her money, and it will discover that she put £100,000 in something she shouldn't have because she got some bad advice, or something like that. Then there'll be local MP who will say it's outrageous that the people have to do this, and then the FCA will pile in, gallop in, and basically just kick the hell out of everybody. I give that about 2.5 years.
And then the lady at that table.
Graeme, I get your model because you enable the investor to have an exit through your trading platform. But I've been really intrigued. If I'm an investor in CrowdCube, what is my exit?
Okay, so every business will state what their proposed exit strategy is. It'll be different across the board. So generally, we tend to see an exit within 3 to 5 or 3 to 7 years of a trade sale is when you'd get your money back. Very occasionally an IPO, very occasionally shares buyback, but it's not a liquid. There isn't any secondary market for it as yet.
But have you done any exits yet?
So we've had, I'll tell you brutal honesty, so we've had the 128 businesses we've funded, 3 have gone down now, and 1 has made an exit but at a slight loss. We haven't had any substantial exits, but what we have had is 2 companies going on to raise institutional money and another going on to raise further funds at higher valuations. So on paper, it's looking good, but we've been running for 3 years now, and having that many businesses still up and running, I think, is only a positive. It's only a good thing.
The thing I'd add in peer-to-peer loans as well is you've got to be careful of the ageing phenomenon. So the late, that's not a problem, but you need to understand it, which is that because they're all relatively new platforms, basically you're only seeing the first year or two aging process of the actual loan structure. And it's a funding circuit has been going just a couple of years longer. You can actually go to their website and see the cohort years and see how they've gone projected versus actual. And they vary enormously, and we should expect that. So all I'd simply say is, because we do write from the investor point of view as well, is that be careful about taking existing statistics because they're backward-looking numbers. Yes. Aging is a phenomenal power in 3 to 4 to 5 year maturity on loans. I'm a bond investor traditionally, and bond investors are taught to think in a completely different way, and therefore, so I would temper. All of the sites are very good in my experience at giving information. I can't fault them. I think they're all brilliant at transparency, but it's of a limited data set value.
So lady over there.
Hi, I'm Natalie from the National Coastal Tourism Academy. We work with businesses to help them grow. Lots of different businesses across the sector. By their own admission, some of them aren't overly creative, and we've emphasised the point of selling your business. Forgive me because I've not been on your website yet, but I was just wondering, do you have ideas to help people with their marketing strategy to encourage investors, or is that something you might consider putting on your website for them to refer to sort of spark that creative approach to selling their business?
No, absolutely. A marketing strategy is hugely important, and when you apply, you will be assigned an investment analyst who will guide you through the process of getting investment ready, getting a business plan together, video, projections, and all the advice and feedback that we can throw at you. Our most successful entrepreneurs listen to us, and the ones that don't generally tend to fail. So marketing strategy is definitely something that we help with, and it's my personal favourite. We've created, week by week of what you should do when and what everything you can do across the board. So social media, doing an event, doing a launch party, making sure that you're talking to people face to face. You're downloading CSV files of your LinkedIn profile and your contacts, connections. There's so much that can be done. Publicity, press, PR, as well as just being creative. Anything that you can do which is going to try and make you stand out from the crowd. Your branding is going to be hugely important. Even that split second where people see you and they get turned on or turned off by that first image, it's important. So yeah, we will share that information as much as we can, but it will be down to you at the end of the day to actually implement it.
Could I add to that? What I did, I sort of looked at ones that have been successful and tried to reverse engineer it. So, well, what have they done? What have they got in their video? How long's the video? How many updates have they done? Things like that, and just try to learn. Success leaves clues, and learn from other people's successes, and just research. Everything I could find online about what makes a successful campaign.
And the other thing you can do is looking at reward-based crowdfunding. The Kickstarter and Indiegogo models. They're not exactly the same, but because they're not dealing with return on investment, economic return on investment. But the same principles apply of inspiring and exciting a crowd of people. You get really crazy creative stuff there. I saw this one which was this guy sat on a toilet for 2 weeks with a webcam filming him to try and get some attention, and he was 16 times overfunded.
What's he going to do with them?
It was a toilet paper company.
Hello, I'm Denise Barlow from Solent Grove Hub. Can the panel give me one reason each why we should suggest to a local growing business that they should talk to you rather than the banks? Is that a bit too far?
Well, I'll give them time to think because I don't have to. So I'm not in the business of selling a platform. I think the reason they should is that two things. The early stage will start at capital I think is impossible to get from banks. And if you had any success, well done to you, but I've never run into any yet. So early stage does need alternative sources of finance. And I think the variant models on display here, I think are a very good idea. Growth capital, though, is important as well. And I think, I probably undersold it, but I think Graeme actually probably put his finger on it as well, which is that whilst it is possible to get growth capital, working capital to grow a business, the banks quite often put so many strings around it, in terms of personal debentures, and actually the platforms will as well, but put strings around it in terms of personal debentures. They tie it into selling you all the crap that actually where they make their money in terms of margins. We all know what happened with interest rate swaps and that kind of stuff a few years ago. The fees, and then I think the crucial thing is speed of demand, speed. And I think Graeme mentioned that point. I think it is well. A lot of the platforms is very valid. You could get money out of these platforms in weeks. And I don't know about you, but my experience of banks is you don't get anything out. You don't. Yeah, exactly. You're lucky to get an appointment in weeks. Yeah, and then actually get sent off to some credit risk shed in India, which is where they do it all. And then it comes back 3 months later, and a good chance they'll say no. So I think those are the two. So it's growth capital, however you display it, as equity or debt, and early stage capital, where I think the banks are woeful in. Okay. And I think these collective platforms have a validity.
I'd like to say I think you just got a better chance of success. That was my experience. I mean, if you go and try and talk to one person, a bank manager, if you can get that appointment, as you say, you convince that person or not. Whereas if you put it out to the crowd, you potentially you only need 1% of 1,000 people to back it, whereas you need to speak to 1,000 bank managers to get the same response.
I'd like to ask a second question. Do you think it's because of the net that it's enabled this new business model?
Well, you can approach, we have 70,000 registered investors on CrowdCube, so you're exposing yourself to all of them in one go, as well as your own networks and talking face to face with as many people as you can, but you just have such a broader reach.
So I think actually you raise an interesting point. I'll be very quick. But actually, what these guys are doing is what AIM, the alternative investment market. When the stock exchanges originally built, they were built as kind of venture capital exchanges, and so AIM was set up to be the alternative investment market for growth companies, and it never really worked because it got captured by the corporate advisors. So what I think technology has enabled in each of the individual cases is they've enabled these online exchanges and marketplaces to emerge to enable growth capital. So I think technology has been a key factor.
So we're in the growth capital sector as opposed to the startups. And what we're offering is speed and certainty. And people who are growing their businesses who have to lay out some money now, you've got a contract sitting there, and you've got to lay out 30,000 quid. It's going to give you 150,000 of turnover over 4 years. You really want to do this, but you've got to know you've got the money. And actually the cost of the money is fairly irrelevant under those circumstances. You just want to know you can do it. What we give you is a very, very fast decision. Yes, we can do it. Or no, we can't do it. And if we say we can't do it, we say why. And the moment we say we can do it, goes through the process, every single auction we do is filled. So they get certainty. The money may take, let's say, 3-4 weeks, but they'll know before that, probably after 2.5 weeks, the moment they've signed the documentation, it's gone back out to us. And we've had clients who have signed the documentation, launched the auction, and immediately gone out to their banks and started renegotiating so they get better deals alongside us.
Gentlemen.
Thank you.
Thanks. First I just wanted to reinforce the point David was making. We had a client get money from the funding circle before the bank could even process their application for them. So it's no brainer. But my question actually is for Graeme. In your presentation, you talked about property lending, and I guess that's some form of mortgage. Is that in place yet, or was there something?
There are 3 or 4 different specialist property lenders in the market. We will be coming out with a property product of our own in the course of the next few months.
We've actually funded 2 property crowdfunding businesses as well, Property Moose and Crowd Mortgage as well.
So the existing businesses are lend, invest, assets, There's a couple of others, isn't it?
Real Index.
Real Index, yeah. Wellesley and Co, yeah. Propland, yeah. All of them operate in the secured and property lending space.
Can I just very quickly ask David, I mean, everyone else has sold themselves very well, but could you just explain a little bit about Altfinews? Because not many people have heard about it, and it might be you could just...
Oh, I'm like you, not very good at selling myself.
I don't believe that for a minute.
Yeah, nor do I. So we cover the sector from an industry point of view, really. So what we do at altfi.com is we talk about it from a trade perspective. But we're launching in about a month's time a thing called the Funding Centre, which is exactly aimed at your market. The tagline is, no high street banks, no finance brokers, just go direct. And we provide a lot of detailed information which allows you just to go straight to the platforms. Because actually we think that the devil is in the detail, and I think, was it you, Graeme, saying you don't matter what the interest rate is. That's not true, but you do care what the interest rate is. But actually what you care about is what the documents I've got to do, what's the debentures I've got to do, what the fees, how long will it take, and that's where we're focusing our attention on. It'll be ready in about a month's time, fundingcentre.com.
Good summary. I read some stuff last year about crowdfunding of invoice finance. Could you just talk briefly around that?
Yeah, there are two big businesses to do it: Market Invoice and Platform Black. Yeah, I mean they are what you described. So effectively, you go on those platforms and you tender your invoice, and then you get other investors buying into it, usually kind of 1 to 1.25% per month kind of rates, maybe up to 1.5%. And they're great. And I said, when I talked about it at the beginning, I was mentioning it's part of the trade finance ecology. I think that area is very, very interesting. But again, I'd point out that actually, I think Market Invoice is just a bigger player. Just literally this week, didn't they, Ryan? They said 200 million, wasn't it? And 200 million of total transactions. But if you bear in mind that actually that's 200 million of total, and most of their duration is what, 90 days, 60 days, something like that. Actually, they haven't got enough origination. They're desperate for business. Or both of those platforms would willingly take more business. And at the moment, I don't think it's unfair to say that they're getting a lot of their business via finance brokers who are using it as effectively a secondary source of funding. But actually, I think those kind of businesses would love to see more direct business come to them. But I don't think people know they're there, being honest.
Any more questions?
Can I ask a question about due diligence? I mean, all of you have due diligence to do before you make your investments. What's the degree of support that you need to put in place to help people put their due diligence together? How easy is that process, and how do you find that?
Yeah, so I'll talk about that a little bit. We've integrated a due diligence tool, so any claim that is made within the text is easy to highlight and then reference with a claim backed up on the line or with a document or something like that measure. Then we'll really drill down into the numbers and the details. Our investment analyst will go through with their figures with the business. Everything is checked for financial promotions, like we say, and the process takes around about a week to 10 days or so.
And that's covered in your fee, is it?
Yep. So our fees are very, very straightforward. There's nothing up front, no listing fees, no upfront fees. There's 5% on success.
I get rather nervous when I hear the words due diligence, because it means very different things to different people. What we're doing is vetting financial information, sense checking it, if you like.
Yes.
And through the interview process, that in itself provides some sort of validation as to whether it sort of fits into a structure or not. I mean, we're also, for example, looking at bank statements over the last 6 months to validate the information that's been provided, which would include, for example, a list of loans. You're suddenly going to find a loan repayment that they haven't got on their list of loans. And that sort of thing is really important, and it would just make us reject something. But I wouldn't say that we do any sort of comprehensive due diligence.
Nothing that's legally dependable. I mean, if, for example, let's take a scenario where, for example, later down an investment's made and some information that you provided has found to be incorrect, factually, materially incorrect.
We haven't provided the information.
No.
The information is provided by the borrower, and the borrower has to sign off on the loan presentation before
Yes.
we will display it. And they have to confirm and warrant that that is correct information.
And if it's not?
Then it is not, I mean, we have done what we can
Yes.
to screen investments. We are not taking responsibility for the information which is put on the platform.
But this is really where it comes back to my first question about regulation. I mean, you know, what's the situation in the crowdfunding model?
Yeah, with it in exactly the same sense, really. I think we do a level of due diligence which says that every claim that is made is backed up by something. But if things come out of the woodwork, often we find that the crowd will love to drill down into the details.
Yeah. Yes.
And you know, they like to be the people that say, I'm out, and for this reason, you know. So that's really fascinating. And it does give that layer of protection in a way when you've got a lot of eyes looking at it, which I think is kind of fascinating. But from a regulatory point of view, we purely fact check and do our own, we say we're comfortable with the business financially and kind of from a kind of perspective.
But if I make an investment based on your statement that you've just made, we are happy with the information we're given. Am I then, what is the regulatory situation for me wanting to sue you if things go wrong? I mean, is there anything on that? What is the basis of that?
It is something I think we try and protect ourselves legally as much as we can. And put the emphasis onto the company to make sure that it is.
I think it would be the same requirements as if, using my example, AIM and LSE exchange requirements. You know, the LSE can only validate when the company comes to list the prospective and listing documents. And then if the company's downright live, which has happened on flotations, you can't knock the exchange out. You have to knock out the advisors to the company in the case of a listing. Because otherwise it would put a chilling effect on provision of marketplaces.
Yes.
But if the provision of the people who provide the marketplaces must effectively not only do the due diligence but vouch for the due diligence,
Yes.
then that would just add to the cost and regulatory burden, and no equity capital will ever go into these businesses because somebody would be worried they get their asses sued.
Yes. But in that situation, in an AIM situation, you've got the no man to go after.
Yes, true. You have. That's exactly right. And that's go spade to spade. This is the riskier end of the capital spectrum, and that's why I just keep saying, you know, with the honourable exception, I think, of some of the more consumer peer-to-peer guys who are putting protection funds in place and that kind of stuff. But they still have the same issue, but they are trying their best in that model. This should not be rainy day money. It's not appropriate. And
it is a work in progress, I think.
Yeah.
You know, it's changed a lot, like we were saying, since when Daniel came and raised the funds. We've implemented a whole lot more, many layers of barriers that businesses have to get through before they can list on our site now.
I think what's going to happen in the lending industry is that you're going to have a huge increase in volume, and the increase in volume is going to generate enough capacity for people to deal with risk for insurance companies to come in and offer products if platforms don't do it themselves.
Well, they already are. There's some platforms doing it.
Yeah.
Okay.
One last question, sorry.
The other point is that it's diversification, isn't it? I mean, your lenders are spreading their risk over dozens and dozens of investments. And so, if you said with FundingKnight, can you see that the average? What was the average?
27% of our investors have got more than 40 individual investments.
Yes, exactly.
And I mean, it's a message we keep pumping out.
Yeah.
And then when a new investor comes in, we say, well, look at our loan exchange rather than participate in possibly 3 auctions that are going on. Why don't you buy 20 small investments immediately, and then you've immediately got some base from which you can build.
But I would add
your own due diligence.
I would add the caveat to that, though, of my earlier aging point, okay, which is it's a new industry, and therefore you're seeing a new volume of book come through. And second, I would add the caveat that although you are diversifying individually on each of the platforms, it is still, you're susceptible to the business cycle. Because, let's be real, if there's a recession, interest rates go up, there's a reasonable expectation of increase of defaults. So I'd add that caveat.